Imagine turning a small amount of money into a fortune. Not by gambling, not by chasing trends, but by thinking differently. Most people dream of doubling their money overnight. The smart ones, however, focus on never losing it in the first place. The difference between these two mindsets is the difference between fantasy and fortune. Let's talk about how to invest small amounts and still get returns that others call impossible. Not through magic, but through method. The first thing you must understand is that the size of your capital doesn't matter. What matters is the size of your reasoning. A small investor with rational thinking will always outperform a rich fool swimming in noise. Money is just a tool. Your mind is the engine. If you stay rational, avoid envy, and make decisions based on logic instead of emotion, you can start with very little and still build something substantial. The world rewards clear thinking far more than it rewards a large wallet. Now, before you even think of being brilliant, focus on not being stupid. It's astonishing how much money people lose by doing obviously foolish things. Buying what everyone else is buying, chasing the latest hype, and selling in panic when prices fall. You don't need to be a genius to succeed. You just need to consistently avoid disaster. The secret to high returns often lies not in extraordinary moves, but in the disciplined avoidance of dumb ones. In investing, avoiding stupidity is a superpower. Then comes patience, the hardest and most profitable skill. Compounding is not fast, it's slow magic. It rewards the calm and punishes the restless. You don't get 50% returns by moving money every week. You get them by finding something great and letting time do its quiet work. Every tree grows in silence. Every fortune grows in patience. The problem is most people can't sit still. They confuse activity with progress and end up feeding the brokers instead of their own wealth. When the right opportunity comes, you must act decisively. Real investing isn't about collecting 100 average ideas. It's about spotting one exceptional one and betting with conviction. But that requires deep understanding, not blind faith. When you know what you're doing, when the odds are overwhelmingly in your favor, hesitation is the enemy. Be bold. But only after you've done the homework. It's far better to swing hard at a few fat pitches than to keep swinging at everything that moves. Learning never stops. Every mistake you make, and you will make many, comes with a tuition fee. The smart investor pays attention and doesn't pay twice for the same lesson. The market is the best teacher, but it's also the most expensive one. Read, observe, reflect, and adapt. Knowledge compounds faster than money. And the investor who keeps learning eventually gets results that look like magic to those who don't. But in the end, it all comes down to character, integrity, discipline, and independence of thought. These are the true engines of wealth. Markets will always tempt you to cheat, to copy, to conform, to trade your principles for quick profits. Don't. The real edge lies in doing what's right, even when it's not popular. Charts and formulas can't measure it, but character decides who holds onto wealth and who loses it. The path to 50% returns isn't paved with secrets. It's built on timeless principles. Stay rational, avoid stupidity, be patient, bet big only when it's obvious, keep learning and never compromise your character. Do that, and over time, the numbers will take care of themselves. Most people will still look for shortcuts. Let them, because while they chase the next miracle, you'll be quietly compounding, not just your money, but your wisdom. And one day when they ask how you did it, you can smile and say the truth. You simply played the long game with a calm mind and a clean conscience. And that made all the difference. Every fortune, no matter how large, begins with a small and often humble start. The mistake most people make is thinking that they need a lot of money to begin investing. In truth, they need a lot of discipline and a little common sense. A small amount, when handled with rational thought and long-term perspective, can outperform a fortune guided by emotion and impulse. The real wealth isn't in the numbers in your account. It's in your ability to think clearly when everyone else is confused. When you start small, you are actually giving yourself a priceless gift. The freedom to make mistakes that won't ruin you. Small beginnings teach you judgment. They allow you to learn how markets behave, how patience feels, and how greed disguises itself as opportunity. Most investors blow up because they start big before they've earned the right to. It's far better to test your logic on a small scale, to refine your thinking when the stakes are low, and to build the muscle of rational decision-making before size tempts you into arrogance. Thinking big doesn't mean taking wild risks or dreaming of quick wealth. It means having a vision rooted in long-term reality. You think big by asking, what happens if I do this consistently for 10 years, instead of how much can I make this week? The person who can delay gratification, who can stay focused on steady compounding, will always outgrow the person chasing excitement. In investing, the tortoise really does win, not because he's fast, but because he never stops moving in the right direction. Staying rational is what separates the investor from the gambler. Markets are emotional machines. They tempt you with greed, scare you with fear, and constantly whisper that you're missing out. To succeed, you must learn to detach from that noise. Rationality means making decisions based on facts, not feelings. It means accepting that you don't know everything, that uncertainty is normal, and that good investing is less about prediction and more about preparation. The rational mind doesn't panic in a downturn, nor does it celebrate wildly in a boom. It simply observes, calculates, and acts only when the odds make sense. When you combine small beginnings with big thinking and rational action, you build a foundation that can carry enormous success. You don't rush, you don't follow the crowd, and you don't let your emotions dictate your moves. You use logic as your compass and patience as your engine. Start small, but think in decades. In the end, it's not the size of your start that matters. It's the quality of your thinking that determines how far you go. The world loves stories of brilliance. The genius who spots opportunities others miss, the visionary who multiplies his wealth overnight. But what people rarely talk about is how most success in investing doesn't come from doing something extraordinary. It comes from avoiding the ordinary mistakes that destroy capital. It's not brilliance that keeps you rich. It's the quiet, unglamorous art of not being stupid before you try to be clever. Make sure you're not careless. Every investor wants to find the next big winner, but few take the time to build a system that protects them from themselves. Emotional decisions, blind trust in tips, overconfidence, and the endless urge to do something. These are the silent killers of wealth. You can spend decades studying finance, but if you can't control your impulses, you'll still lose money. Avoiding stupidity means understanding your own weaknesses. It means being humble enough to admit that the biggest threat to your portfolio isn't the market, it's you. Many people chase brilliance because it feels exciting. They want to outsmart the system, time the market, or uncover secret formulas. But here's the truth. You don't need to be a genius to make money in investing. You just need to consistently avoid doing dumb things. Don't buy things you don't understand. Don't borrow money to gamble on uncertainty. Don't panic when prices fall or become euphoric when they rise. If you can simply stay rational when everyone else is losing their mind, you've already beaten most of the competition. Avoiding stupidity is also about knowing when to say no. Every opportunity looks good at first glance, but discipline means passing on 9 out of 10 of them. The investor who avoids the bad bets lives long enough to find the good ones. A few wise decisions, combined with years of not doing foolish things, can lead to results that appear brilliant, but they're really just the outcome of careful avoidance. The irony is that true brilliance often hides in simplicity. It's in the investor who resists greed when others rush in. It's in the one who holds steady when the crowd panics. It's in the person who builds wealth slowly because they refuse to lose it quickly. By focusing on what not to do, you create space for the right actions to matter. The goal is not to look smart. It's to stay solvent. Because in investing, survival is brilliance. Patience is the rarest skill in investing, yet it's the one that quietly creates the most wealth. Everyone wants results, but few are willing to wait for them. The irony is that the market transfers money from the impatient to the patient every single day. Those who can delay gratification, who can let time work in their favor, end up with returns that seem almost magical, but it's not magic. It's math combined with discipline. Compounding is the greatest force in finance, but it only works if you let it breathe. Every dollar you earn has the potential to earn another dollar, and then another, but people interrupt this process constantly. They chase quick profits, switch strategies, panic at small losses, and sell what they should hold. Impatience turns potential fortune into wasted motion. The patient investor, on the other hand, understands that the real power of compounding doesn't show up in months or even years. It shows up over decades. Patience isn't just about waiting, it's about waiting with purpose. It means trusting your process, even when results don't show immediately. It means resisting the urge to act just for the sake of action. In markets, inactivity is often intelligence. The best investors spend more time watching than trading, more time thinking than reacting. They understand that time is not their enemy. It's their greatest ally. Every tick of the clock either compounds your returns or tests your resolve. The market loves to play with your emotions. It will tempt you with fast gains and scare you with sudden drops. Most people respond emotionally, and that's why they lose. Patience is emotional control disguised as strategy. When you can stay calm through volatility, when you can see a 30% dip and not feel panic but opportunity, you've already separated yourself from the herd. Wealth is rarely built by the smartest. It's built by those who can endure boredom and uncertainty without breaking their discipline. True patience is built on understanding. If you know what you own and why you own it, you can wait as long as it takes. The impatient investor needs constant confirmation. The patient investor needs only conviction. And over time, the difference becomes enormous. Patience turns small sums into great fortunes, slow progress into exponential results, and quiet confidence into lasting success. In the end, it's not timing the market that matters. It's timing and inerting the market. Those who master patience don't just make money, they make history. Success in investing doesn't come from having hundreds of opinions. It comes from having a few that are right and the courage to act on them. The world teaches diversification as safety, and for beginners it often is. But the truth is, spreading your money too thin can also spread your focus too thin. Real wealth is built not by being everywhere, but by being right where it counts. When you find an opportunity that you understand deeply, where the odds are clearly tilted in your favor, that's when concentration becomes not a risk, but a strategy. The key is judgment. You don't bet heavily on every idea. You wait for the rare ones that are obvious after deep study. Most of the time, the smartest move is to do nothing. But once in a while, you come across a situation where value and logic line up perfectly, where your understanding gives you a clear advantage over the crowd. Those moments don't come often, but when they do, hesitation is expensive. You must have the conviction to act boldly, not recklessly, but decisively. Acting boldly doesn't mean being impulsive. It means having the courage to trust your preparation. You only earn the right to bet big when you've done the work, when you've studied the business, understood the downside, and tested your assumptions. Most investors swing at every pitch because they're afraid of missing out. The wise investor waits for the fat pitch, the one you could hit even with your eyes half closed. Then, and only then, do you swing hard. This principle separates the thoughtful investor from the gambler. The gambler bets often, the disciplined investor bets rarely but with precision. The gambler relies on luck, the investor relies on understanding, and understanding is what? Gives you courage when others are uncertain. If the odds are truly in your favor, the greatest risk is not acting boldly enough. Opportunity doesn't knock twice, and the market rarely gives long invitations. However, concentration requires humility. You must also know when not to bet. When the facts change, you must change. When the odds shift, you must reassess. Confidence without flexibility is just arrogance in disguise. The art is in balancing boldness with discipline. Daring enough to seize the right moment, but wise enough to wait for it. In the long run, fortunes are built not by constant activity, but by a few well-timed, well-researched, and well-executed decisions. You can't get extraordinary results from ordinary conviction. When the odds are overwhelmingly in your favor, that's your moment. the time to act with clarity, courage, and commitment. Because in investing, you don't need to be right often. You just need to be right and big when it truly matters. The market is the most demanding teacher you'll ever meet. It doesn't care about your ego, your degree, or your confidence. It will humble you, test you, and charge a heavy tuition fee for every mistake you make. The only way to get your money's worth is to learn relentlessly, especially from the painful lessons. Every loss, every bad decision, every missed opportunity carries wisdom in disguise. The people who grow rich aren't the ones who never fall, they're the ones who never waste a fall without learning from it. Most investors treat their mistakes like wounds to hide, but the smart ones treat them like textbooks to read. When something goes wrong, ask why, not emotionally, but rationally. Was it a failure of analysis, a lapse of discipline, a decision made under emotion? The answers to these questions build the foundation for future success. Every bad trade or poor judgment becomes tuition for the next great one. The cost of learning is unavoidable, but ignoring the lesson makes it infinitely more expensive. The truth is, success often makes you complacent, while failure makes you wise. When things go well, you start thinking you're a genius. But when they go wrong, you're forced to confront reality. And reality is the best tutor there is. Pain has a way of focusing the mind. It strips away illusion, exposes your weaknesses, and leaves behind clarity. That clarity, if used correctly, compounds faster than money. The investor who learns constantly from books, experience, and reflection is unstoppable over the long run. Learning relentlessly means treating knowledge like capital. You reinvest it, you compound it, and you protect it from arrogance. Read broadly, study history, and watch how human nature repeats itself in every market cycle. The mistakes people made 50 years ago are still being made today, just with new names and shinier technology. By learning continuously, you avoid paying for lessons others have already bought. But the real growth happens internally. You can read every book on finance and still fail if you don't learn how to manage your emotions. The most valuable lessons in investing aren't about numbers. They're about temperament, how you respond to loss, how you handle success, how you stay objective in chaos. These define your long-term results. The relentless learner doesn't just study markets, he studies himself. In the end, the market rewards the humble and punishes the proud. Every mistake you make is an invitation to become wiser. If you accept it, keep learning, keep questioning, and never think you've figured it all out. The moment you stop learning, the market will remind you why you should have kept going. Knowledge compounds quietly, just like money, and those who keep feeding it, especially with lessons born from pain, eventually achieve mastery that looks effortless to everyone else. In the long run, numbers don't build wealth. Character does. Charts, ratios, and models can tell you what a business looks like on paper, but character decides how you behave when things stop going according to plan. The market constantly tests your temperament. It doesn't care how brilliant your analysis is if you can't control your emotions. Discipline, honesty, and independence of thought are what truly separate lasting success from temporary luck. A chart might tell you where the price has been, but it can never tell you what kind of person you are when the price drops. When panic hits and the crowd runs for the exits, character decides whether you follow them or hold your ground. The ability to stay calm when everyone else is losing faith isn't taught in finance textbooks. It's built through experience, humility, and self-awareness. In those moments, charts are useless, integrity and inner strength are priceless. Good character protects you from the most dangerous enemy in investing, yourself. Greed makes you reckless, fear makes you blind, and arrogance makes you deaf to reason. A person of character can resist all three. They don't chase fads, they don't lie to themselves about risk, and they don't compromise principles for short-term gain. When your foundation is built on values instead of vanity, you don't crumble with the next market crash. You adapt, learn, and endure. In every great investor's story, you'll find one constant. They never let emotion overrule logic. They stay consistent even when results aren't immediate. They treat success with humility and failure with curiosity. That steadiness comes not from intelligence, but from character. Markets reward rationality over brilliance, patience over excitement, and honesty over illusion. The investor who can admit mistakes and stay true to sound principles outperforms the one chasing perfect predictions. Character also means having the independence to think for yourself. It's easy to follow the herd when everyone's euphoric. It's harder to stand apart when your convictions make you look foolish. But that's where real wealth is built. The courage to be contrarian when you're right and humble when you're wrong comes only from a deep moral core. Without it, even the best analysis becomes fragile. In the end, charts only show the past. Character shapes the future. Your habits, your honesty, your patience. These determine how you respond to uncertainty and whether you survive long enough to see compounding do its work. Technical skill might get you started, but moral strength keeps you standing. In a world obsessed with signals and systems, character remains the ultimate edge, because it never goes out of style and it never loses value. In the end, the path to extraordinary returns isn't hidden in secret formulas or complex charts. It's found in timeless principles that demand discipline more than brilliance. Start small but think big. Protect yourself from foolishness before chasing greatness. Be patient enough to let compounding work its quiet magic. When opportunity truly tilts in your favor, have the courage to act decisively. Keep learning, especially when it hurts, and let every setback sharpen your wisdom. And above all, build your foundation on character, because no amount of intelligence can save a person who lacks integrity and emotional control. The truth is, you don't need to be extraordinary to achieve extraordinary results. You just need to do a few simple things consistently, while avoiding the temptations that destroy most investors. Wealth doesn't come from constant motion or blind optimism. It comes from calm thinking, steady action, and a refusal to be swept away by the crowd. If you can master your patience, your judgment, and yourself, the returns will take care of themselves. So invest wisely, live rationally, and play the long game, because in a world chasing quick wins, the real winners are those who think clearly, act slowly, and let time, the most loyal partner of all, do the heavy lifting.